You measure any asset you want against gold going back all the way probably to 1971, and you will see everything is falling in gold terms, but going higher in dollar terms. This is the insidious hidden inflation that we don't talk about.
Welcome to another episode of the Kinvestor Report, where I chat with industry experts to discuss the market, commodities, stocks, and the economy. As always, I'm your host, Arlen Hansen. This interview is not investment advice, should not be construed as such. As always, if I have any financial interest in any companies mentioned in today's interview, both personally or within my business, it will be disclosed. Once again, this interview is not investment advice. Do your own due diligence and don't be stupid with your money. There's a growing narrative in the market right now that something bigger is happening beneath the surface. Not just price action, but a structural change. I feel it. And today's guest is someone who's been at the center of this conversation for quite a while. Andy Schectman, president of Miles Franklin, one of the most recognized precious metals firms in North America, and a relentless voice on the shifts happening in the global monetary system. From central bank gold accumulation to the acceleration of de-dollarization to what he calls the largest wealth transfer of our generation, Andy's been connecting the dots that most of the market is still ignoring, and I can't wait to pick his brain on this. While mainstream attention stays fixed on price, Andy focuses on who's buying, why they're buying, and what the signals about the future of our currency and trust. Lately, his message has only intensified. We're not just watching a bull market, we're watching a complete reset. So today, we're going to break that down. Andy, super happy to have you on the show today. How you doing?
I'm all right, brother. Great to be here. Thank you for having me. Appreciate it very much.
Right on. So forget the price about gold and silver, although that we will be talking about that. What's happening underneath the market right now that investors just are not seeing?
Simply the deliveries. The deliveries all around the world are exposing the narrative that the markets have topped, that gold and silver are overbought, that things are correcting and may not come back. I'll give you an example. Price is a tool of misdirection, simply. But let's start with January, February. The markets got their teeth kicked in. Gold and silver collapsed. Now, the first thing that happened was the Bank of International Settlements, which is the most powerful bank on the planet. Well, they came out and said something that, again, people didn't catch, and that was that the correction was not fundamental. The correction was, in essence, synthetic. The correction was a function of two things. It was orchestrated. It was a function of, number one, in January, all of the levered ETFs, which had seen silver and gold move up unabated week after week after week after week into the end of the year, well, their prospectus demands and mandates rebalancing the first or second week of January. That period of time is notorious for asset prices as ETFs rebalance to the conditions that they were founded on or designed upon. And the second thing that happened was, and this really highlights the BIS saying this was a structural change, not a fundamental one. In essence, I thought they were taking the CME group, the commodity exchange, COMEX, to the woodshed, saying, what the hell were you guys thinking? Because at the exact same time that we could guarantee selling to rebalance, which in a market that had moved that high was guaranteed, the CME group in their infinite wisdom raised margins by 300%. And so in December, for a company like mine, or a speculator who was just trying to speculate, if I have 2 million ounces in my warehouse, I will sell 2 million ounces of silver on paper so that I am market neutral. One goes up, one goes down the exact same amount, so I can be neutral with my inventory. That cost me $15,000 roughly at the beginning of December. By mid-January, that was $54,000. And so you have to have $50 million in a margin account just sitting there as collateral just to hedge the silver, let alone the gold and the platinum. No big deal. But for a speculator, let's say a speculator, and silver was $60 in December roughly, had $110,000 in a margin account. Well, that in essence would control each contract, 5,000 ounces apiece, would control roughly 3,000 ounces, or excuse me, $300,000 worth at 5,000 ounces for $15,000. Within a month, that $15,000 had to be $54,000. So at the $15,000 mark, 110,000 would have covered 7 contracts. Well, you would have needed, he or she would have needed to post over $200,000 in the period of a month just to maintain that same position. And if not, the whole thing gets margin called, sold off. That selling begets selling begets selling on top of the unwinding or the rebalancing of the ETFs. It was guaranteed synthetic orchestrated slam down 1,000%. The BIS said this. All right, let's leave that as the foundation. So in February and March, China came in with unprecedented silver demand, with their imports surging 80% month over month to a record 836 tons in March. And now let's just do the math. Now, February was the all-time high that they ever imported. March was even more. And so 2 months in a row of all-time high imports for the second largest producer of silver in the world, deciding, well, for the second most in recorded history. Now, people don't understand what 836 tons are. So let's just do the math here real quick. Let's go 32,150 ounces approximately times 836. Well, that's 26,877,000. But if you look at the amount that they imported for the whole first quarter, the first 90 days, it was like 1,260 tons, give or take, times 32,150. Actually, it was even higher than that. It was roughly 55 million ounces that they imported the first quarter, the first 90 days of this year. As the price got its teeth kicked in, that's just unprecedented. Well, the same thing is true here in the United States. So we've seen every month now for going on 18, 19 straight months, deliveries that are off the chart, literally off the chart. No one's ever seen anything like it. And we'll use February as an example again. So using February as an example, and by the way, China, it's 17 straight months of accumulating gold and silver, not just silver, 17 straight months of accumulating gold and silver.
Net import.
Their year to date, I have it right here, was 1,626 tons. So let's just do the math one more time. 1,626 times 32,150, 52,275,000 ounces as the price was being destroyed. On COMEX, in the month of February, we saw 26 or so million ounces delivered, which was a small delivery because the even months, let me just make sure I'm right on that. No. The odd months are deliveries for silver. The even months are for gold. So January is a primary delivery month. February is not. March is. April's not. May is. So February, non-primary delivery month, we still saw 26 million ounces of silver delivered, about $1.4 billion worth. But what's more important than that to me, and I want you to think about level of sophistication, wealth, coordination, etc., motivation. Somebody, some entities or entity took possession of 39 million ounces, which left COMEX. Now, when you take a delivery, it doesn't mean it's being delivered out of COMEX. Could sit in a COMEX vault in an eligible category, not for sale. And a lot of people do that. A lot of institutions do that. Okay, 160% of what was delivered, what deliveries could explain alone, left the COMEX market. That is 2.8 million pounds of silver, got on semi-trucks, an armada of them, and drove away. Now, who in God's green earth is taking possession of $4 billion worth of silver in the form of almost 3 million pounds? And where's it going? When you pull a bar out of COMEX, when it leaves the doors of the COMEX facility, it is done. It ain't coming back because it would need to be drilled, filled, and re-entered into the assay system, which would take forever at a big cost. When it leaves, it's never coming back. Now, this has gone on continuously, unabated, month over month over month over month over month over month, and not a word from the mainstream. Not a word. And so when you talk about, gold and silver, in China, in the month of March, 162 tons of gold, the highest since March 24 of 24, third consecutive monthly increase in a row, 17th consecutive monthly purchase. The world, not just China, but not just the United States, we're seeing it everywhere. Poland. How about Tether? Tether has more gold. They've been accumulating more gold than any central bank on the planet. Everyone is using the in my opinion, the cover of suppression of price to stand for delivery, here in the United States especially, the most well-informed traders on the planet are doing that. But one other thing that people are missing, I have a very, very good friend who is a broker of mine at Morgan Stanley. And he's one of the biggest in the country. He manages over $4 billion. He's in the Forbes top 40 list. I've known him for a long time, and he's kind enough to manage some of my money. And their chief investment officer said, he came out publicly, the chief CIO, and he said, the 60% stock, 40% bond strategy that Wall Street has used for 50 years is dead. We need to sell half of our bonds and put 20% of your assets in gold. Well, my buddy, who is a bigwig at Morgan Stanley, wouldn't know gold coin if it fell on his foot. Never talks about it. So they're talking to people way up here, even higher than a Forbes top 40 broker. And you got Michael Hartnett, the chief analyst for Bank of America, chief analyst, whose newsletter is many thousands of dollars and only goes to the institutionals. He said, yeah, make that 25%. Or Jeffrey Gundlach, the bond king, 25% isn't overweight, he said. And this is a guy that made his life on selling bonds, the antithesis of gold. You got banks like JP Morgan, like Wells Fargo sees the potential to move to $8,000 gold by 2027. UBS, JP Morgan, Deutsche Bank, Bank of America, they're all 6,000 plus within the next 12 to 24 months. That's what they're saying. Even BlackRock came out and said they're pivoting away from their 60-40 portfolio, increasing exposure to commodities, including gold-related assets. So when I look at what is being missed, what people aren't talking about, they are being misdirected by the price as the most well-informed. Forget about the wealthiest. Those are the central banks that have been buying it for 9 straight years quietly. It's whoever's doing it here, and what is being missed has nothing to do with price, has nothing to do with fundamentals, has nothing to do with corrections. It has to do with who the hell is standing for delivery every single month. I live on a golf course in Florida, and
I'm not surprised.
It gets hot here. I moved here 5 years ago, and I was fortunate enough to do that. And I've never lived on a golf course. I never was anything related to country clubs. I come from nothing, man. And when I moved down here at the height of the pandemic, property values were decimated, and it was a song and a prayer. I was here well before things got nuts. But it's hot in July here. It's very hot, and if I live on the first tee box, I have 2 snowmobiles back at home in my sister's garage in Minnesota, where I spent 50 years of my life. And if I woke up July 4th to 4 feet of snow on the tee box, I wouldn't call my sister and say, send me back my snowmobiles. I'm going for a ride. Because when I tell you the deliveries that we've seen over the last 18 months are 4 feet of snow in July in Boca Raton, it does not happen. It never happens. And the amount of deliveries But it's true, because the amount of deliveries we're seeing, brother, are so far outside of what has ever happened, normal. Less than 1%. So the only thing that is being missed in my mind is that the biggest, most well-informed, biggest money and most well-informed traders in the world are using the cover of misdirection, of price, and of rhetoric to stand for delivery. And the journalistic integrity, that they should just be saying, okay, forget about all that. Well, if price was such a hindrance, if price was really indicative of value, then who the hell is spending literally 9 figures every single month for over 18 months in both gold and silver to stand for delivery? And by the way, who the hell just ran logistics and insurance and the armada of trucks, and where is it going? Now, is there any coincidence perhaps that silver is now a critical mineral as reclassified by the government? Is there any coincidence perhaps that Scott Bessent understands gold? He's a gold bug, and that was his largest holding as a hedge fund guy before he became Treasury Secretary. And is it possible that the Exchange Stabilization Fund, which doesn't need congressional approval if for national security, well, what is silver? It's a critical mineral for national security. And he could deem gold to be for national security, as what's happening around the globe with gold being accumulated at record pace. Could it be that it's being brought in without congressional approval, without the acknowledgement, because someone is doing it and no one is talking about it? I talk about it every week. People say I say the same shit over and over again. Sure I do, because it's all that matters. These people, they used to ask Wayne Gretzky, and he's a little guy, He is. And they said, how are you so great? Well, he said, I never skated to the puck. I skated where the puck was going. Do you think people who are spending this kind of money every month for 18 straight months are doing it for the hell of it? Do you think they know where the puck is going? They use price and rhetoric to misdirect as they accumulate on the cheap. It's the exact same thing that happened on COMEX. A synthetic orchestrated drop by the CME group and the rebalancing of ETFs plunders price, and the largest amount of imports ever in the history of China, recorded records, happens. I believe it was perhaps, and I'm not positive, let me just see real quick if I can find it. I think it was the largest delivery in gold in the history of the COMEX also. Now, I'm not positive on that. I read it. I don't think I took notes on this. I'll have to come back to you on that. But bottom line is they're all standing for delivery across the globe, and that's what's being missed.
Yeah, I'm so glad you brought this up because like I've been doing this for 25 years as well, right? And when gold's being suppressed or when gold was like at 800, 1,000, whatever, everyone talked about market manipulation, market manipulation. Then the shackles come off gold, and people stop talking about it. It felt like for the most part. But this is alive and well, is what you're saying, and you're saying this is not normal. The delivery and the system is tightening fast and furious, and now, and that's what people need to pay attention to.
It is, and. I would argue that it's possible, and I believe it is. I have a thesis that I've talked about. Either I'm stupid to talk about it, or I've always said what I believe, and it's my belief that they are now transitioning to a period of time where they want the gold price to go much higher. They want it to move up in an orderly fashion. I think this has a lot.
The Chinese do, or who does?
No, the United States does, and we never did, right? And largely, the commercial banks in the U.S. are getting net long. We saw a report in the Economic Times about that, and we can see it in the Commitment of Traders report. The banks that are mostly net short are those in Canada and Europe. They are being exposed for their short positions. The U.S. got mostly net long. Now, you can be short as a commercial bank, but if you have 12 long and 11 short, you're net long. I believe that trend is moving more and more towards the long side. They want the price to go higher. The first thing would be to onshore. We've seen more gold and silver coming into this country than at any time in history, ever. Not talked about. The second thing you would want to do is to find ways to push the gold price higher. Now, that is part of what I'm talking about with the Genius Act, with Tether, with the Clarity Act, where interest cannot be passed on to the holders of the stable coins. We can get into that if you want, but what does higher gold do? It does two things. Number one, it allows the debt to be paid off, and we talk about a $40 trillion debt, and it's important for people to understand, again, the word trillion. Look, if any of us work an entire career, almost everyone, unless they're getting paid totally minimum wage, will make $1 million over their career. Now, may not save $1 million, but the word million ain't what it used to be, right?
Well, the government will take 55% to start.
Right, right. But you're paid. It may say you made $1 million over your career. Well, what do you have to show for it? But billion isn't what it used to be. But the word trillion just flows off people's tongues, and they don't get it, right? It's only a $40 trillion debt. How big could it be, right? Well, a trillion seconds ago was 31,688 years ago. And 40 trillion, or nearly 40 trillion, ignores Medicare and Medicaid and Social Security and government military pensions. The debt is astronomical, no question about it. But how do you pay down a debt when you have no manufacturing base, when Ray Dalio says 60% of the country is more or less illiterate, has a reading proficiency under the 6th grade, so we're broke, we're insolvent, we're uneducated. We don't make anything anymore. That's called Triffin's dilemma. When you are the world reserve currency, you will always have a trade imbalance because the world needs more dollars than we can provide through trade alone. Let's use Cambodia as an example. We don't trade with Cambodia, so they need dollars to buy oil and to transact globally. So they sell their currency in the open market to buy ours, and we export those dollars. And so over time, the discrepancy between the two currencies gets this big, and so let's send our manufacturing to Cambodia or to Vietnam, who just joined the BRICS. And this is why your manufacturing base gets eviscerated. So how do you pay off a debt when there's three ways really to do it? You can default, you can inflate, or you can produce your way out of it. Well, we can't produce because we don't make anything anymore. We've offshored our manufacturing. Are we smart enough? Well, no. 60% of the country is illiterate. Do we have enough money just to pay it off? No, we're broke, we're insolvent. What do we do?
Your interest payments are like insane.
That's correct.
You can't even pay principal ever.
That is correct, and that's called Ferguson's law.
Yeah.
When your interest payments are higher than your ability to spend on military, which is discretional, has to be borrowed, then a superpower ceases at some point in the near future to become a superpower, is what they say. And the Congressional Budget Office says by 2031, 100% of tax revenue will go just to pay interest on the debt and mandatory off-balance sheet entitlement programs. So in any case, what does the weakened dollar do? It allows manufacturing to come back, perhaps, get into that in a moment, and it also allows you a much easier path to paying off your dollar. How do you devalue the dollar? You don't devalue it against the dollar index, because we can see every currency is selling their currency to buy ours. It's a poor measuring stick. It's a melting ice cube. Instead, you do it against gold, the one neutral reserve asset, the one barometer by which all things should be measured. Let me give you a good example of that. And I say this so many times, I have it ingrained in my mind. 2005, right? You get married, your father left you, he left you 530 ounces of gold. Let's pick that number, because that's about what it worked out to. In 2005 in the United States, in middle America, the average price of a house, according to the Census Bureau, was about $240,000. Gold was $450. Works out to about 530 ounces, give or take. You're talking to your wife, should we sell the gold my dad left me and have no mortgage, or should we save it for Junior because you're pregnant? Should we do that? And she said, let's save it for Junior. All right, we'll take out a mortgage. So you stuff that gold under your mattress, earning nothing but dust. That's what they always tell you. Why would you want to hold something that pays no interest? That's the fallacy, right? Okay, fine. You stuff it under your mattress, you earn nothing but dust. Here we are 21 years later, and guess what? Your house has doubled. Good investment in dollar terms. Your house doubled. But those 530 ounces right now are worth $2.5 million plus, and will buy you 5 houses almost fully furnished, because it's over 2.5 million. And so the point of it is, with the average price now being 500,000, in dollar terms it doubled, in gold terms it lost 500%. You measure any asset you want against gold, going back all the way probably to 1971, and you will see everything is falling in gold terms, but going higher in dollar terms. This is the insidious hidden inflation that we don't talk about.
Cannot deny that chart. There's just no denying that chart, period, hard stop. And
those are the things people are missing.
Yeah, 100%, 100%. I totally agree with you on that. At what point does this, like, the systeming tightening become a problem, do you think? Like, when are these guys, and what is the COMEX going to do to fight this? Like, we all know when people start getting desperate, when we know that when people know they're going to start losing, they start pulling out the cards of desperation. What does that look like, do you think?
Well, this is what I admire about the way the Chinese do things. And this is the hard part. It's a really good question, because it's the hard part for most people who analyze this to understand, right? We live in a world, like I grew up in the 70s and 80s. I'm 55, but I watched the proliferation of things like Texas Hold'em. Became a big deal. Everyone's playing Texas Hold'em and gambling, casinos everywhere. I remember the first time I went to Vegas and, watching it explode in terms of its size. You look at stocks like Apple, and before that you got like Yahoo and all the internet stocks, and you look at Nvidia, you look at Bitcoin, you look at this massive, even a move away, like when I was a kid, you went to a local hardware store. Now everything is Lowe's and what's it called, Home Depot, and everything is big and fast and quick and cheap, and especially in terms of making money. But in terms of making money, it's instant gratification isn't fast enough, and so people dismiss and poo-poo the slow and steady, right? But the Chinese, they see this, I think, as a very strategic, long game. And, so they've been slowly, with 1,000 paper cuts, doing this. For example, they've had an arbitrage going on for over a year on the Chinese Shanghai Gold Exchange, where arbitrages normally settle in terms of days, where the traders will flood that exposure, meaning they can buy it here and sell it there for a lot more money. They will do it, and that arbitrage ceases to exist. They've had varying levels of premium over the Western price, but right now it's about $10 an ounce over the Western price to deliver metal to China. And so if you're a sophisticated trader, in fact, there is a COMEX contract that you can deliver, what's called exchange for physical, to Hong Kong, a Brinks facility, where it will be picked up by a truck and driven to Shanghai, or it can just be sent to Shanghai. But let me give you an example. You're a sophisticated trader. You send them 10 million ounces of silver at a $10 premium. You just made a $100 million profit. You're going to go buy your new yacht in Tahiti. But that should have been gone a long time ago. They keep it going. They're playing the long game. Come on, just give us your silver. We'll pay you an extra vig for it. You should do it. But this has been going on forever and slowly draining the world's exchanges across the globe. And so instead of rushing, people say, why don't they just buy it all? Because the COMEX would force majeure like that. It would shut down. And they would then cut off their nose to spite their face. So it should have been realized a long time ago. And we are beginning to see an acceleration in deliveries. We're seeing it happen all around. The LBMA is running into stress where, according to, what's his name? He's so good too. David Jensen, who is an expert on the LBMA, he says there's roughly 2 billion ounces in paper contracts that could stand for delivery, standing against 140 million ounces backing those 2 billion ounces. So what could possibly go wrong if everyone stands for delivery? It's a 1 out of 15 or so get their metal. So it's a situation where it's happening, and if those that are awake probably already see it. And that's why we're seeing, I believe, slow removal, not too fast to alert the masses. I see it, and I wonder why the media doesn't see it, because to me, it is all that matters. It betrays the price, it betrays the rhetoric. The deliveries by the most sophisticated players on the planet is really all anyone needs to see.
I think the media probably sees it. They just don't want to report it, because if
Or
they
they
report
can't.
it, they might get in trouble.
Right.
Right?
Exactly.
By the people up above saying, don't be telling people about this problem. It's ridiculous. Okay, on to silver. You call silver the most asymmetric trade in the world. Why?